Good morning, traders. Welcome to the Flow Show. We made it to the end of the week, and what a week it's been, and what a week it still is. If the price moves are to be believed. Morning, K-Man. How are we doing this morning?
Morning, Ryan. Good morning, everybody. Thank God it is Friday.
Yeah, looking forward to it. I think there's going to be a few early exits this afternoon.
Oh yeah, my energy level is in the red zone, mate.
Yeah, tell me about it. I was struggling yesterday, but here we are. We'll get into it this morning, and right, well, let's go and see what's going on in the world. China, President Xi, or whatever he is, Premier Xi, is going to meet some US CEOs in Beijing next week, according to the Wall Street Journal. Probably going to try and get some of those investors back into China, trying to maybe repair some relations. We'll see how that goes with, obviously, the big chip argument ongoing with the US, amongst other things. So doing a bit of smoothing. As we've been saying, that's probably one thing that they've been lacking at the moment is they may be trying to fix things domestically, but internationally is another matter altogether. So that may be looking to do something along those lines. Bit of a strange goings on in China, really. We've seen a big jump up in dollar China. There's no real headlines behind the move that I can see anyway. I can always miss something. There's enough been going on this week. Banks, China's state-owned banks have been in trying to prop it up again, but it doesn't seem to be doing the job. I'm not sure if this is Fed fallout or, more moves thinking that they're going to be easing further. I'm not sure, Kay. Can you put your finger on anything for this one?
Probably, a bit of both. There's been some quite negative moves on the Chinese stock markets, and as I was saying as well in the room, it's a bit of a strange one, right? They did not add specific liquidity net overnight. They continued to fix ultra low, and then all of a sudden the thing blew. And I've been trying to look around the time to see if there's been anything coming out, but I may equally have missed it if something really came out of there, because no, and I haven't seen it. And then they still sending their submarines out to sell the rally, to sell this rally at least, but it hasn't had any effect at all.
No.
Yeah, no, it's guessing, mate. Really guessing.
Yeah. That's what I was going to say. The first thing I saw when I looked this morning was perhaps that stock markets have collapsed, but they haven't. So that's sort of had to tick that off the list.
So I think it's probably, again, people. I heard importers were buying dollars, but okay, they probably buy dollars every other day. I think it's probably a combination of just everything, mate. Yeah, the dollar made a comeback, rallied 1% against everything, barring yen, of course. Yeah, I mean, and dollar China just put the same 1% in there, but maybe it's just simple as that, and breaking above that 722 zone, and there we go.
Yeah, exactly. So one to monitor, particularly for me, as I'm still short. If we get above 730, I might have to rethink my plan on that one. But anyway, we'll keep an eye on that. Over in Japan, we had some data out, and it's all coming up roses for the Bank of Japan. National inflation coming in much higher than last month, on and around expectations. As you can see there, core CPI expected at 2.8, came in at 2.8, but still, that's 8 pips above the last month and 8 pips above target as well. So, that's significant for the BOJ. Whether they got a sniff of this previously or just read the Tokyo numbers that come out before this data a week or so ago, helped their decision making this week. But yeah, it's going the right way. Another box gets ticked for them in regards to potentially doing some future hikes. Japan Economic Minister Saito says they are monitoring the BOJ's decision for its impact on capex and lending. Suzuki was out with his usual jaw-boning on FX, but no, he declined to comment on intervention or anything. But he did say that the BOJ's decision to change policy could squeeze policy expenditures. Translation aside, we can probably assume that's talking about government expenditures, you know, what they'll have to start paying out for borrowings and that sort of thing, yields on bonds and stuff. BOJ watchers, according to Bloomberg, who seem to have picked apart the Nikkei story and rejigged it around for their own words. Anyway, they say BOJ watchers thinking that a rate hike might come by October, with a potential risk of faster moves. Reuters ran a poll as well, and 54% out of 35 economists expected another increase in short-term interest rates by the year end. No one thought that June was the date for another hike, but 14% of those 35 said rates are likely to rise to 0.2 or 0.25% in Q3 this year. So the market now doing its timing trade thing over the next BOJ hikes. On the wages front, we had the next Rengo tally up, and the average in that count was 5.25%. That was versus initial 5.28%. So down a smidge, but still way above last year, which so there's not going to be much difference to the BOJ, and they've got an ended nerve anyway, so it doesn't really matter what it comes in now. But obviously, probably now we're moving into a stage, I think, Kay, where, yeah, we're going to get confirmation of these wages are all going to be tickety-boo, and then we have to set ourselves ready for next year to see if they maintain that pace.
Well, that's for the longer term, indeed. The comments by Suzuki about the expenditures and stuff, it may come over a little bit stupid because Ueda and themselves, they know what what the Bank of Japan was going to do, so they shouldn't be surprised about this move. But we have to know that in the diet, the Japanese what is it, Congress also or government, they are questioned about these things virtually every day. So some of those comments may come over as headlines, but we always have to know what's going on in the Japanese diet, and there's always talks about that because people don't always have anything else to talk about. So take those headlines with a bit with a pinch of salt. They are not like really surprised. They know exactly what's going on. Yeah, for the Ringo, it's actually positive because usually when we see those promises and the first tally, the second and the third are always revised quite a bit lower, but this one is still very close to where the original was. So that is somewhere a positive. Yeah, Nikkei is a tad. Where was Nikkei? No, actually, Nikkei was up overnight. No, let me see.
There we go.
Yeah, it was up slightly overnight. So the market is still taking it as quite positive. Everything that's going on around there, and also read some comments from investors saying that they are still very positive about what's going on in Japan. So
yeah, and those inflation numbers are pretty good as well.
Yeah, the inflation numbers are good, and then if you want to take everything apart, the core, which is ex fresh food and energy, is coming down from 3.5 to 3.2%. But okay, it's still far above their 2% target zone. So that is still under supporting what they are doing basically.
Yeah, very much so. Right, let's move on to the good old BOE, Bank of England. They voted in the end 8-1 to keep rates unchanged, both hawks shifting to neutral. As we mentioned yesterday, that was the first thing to look for a non-dovish or slightly moving towards a dovish side, shall we say. depending on how many moved, but both moved. So it was a little bit more dovish in the vote numbers. The statement was largely unchanged at the outset. They're not yet at the point to cut rates, need to be sure inflation hits 2% and stays there. Key indicators of inflation persistence are still elevated, but things are moving in the right direction. Further encouraging signs that inflation's coming down. They also said that a full assessment of the budget impact that was made this month is to be made at the May monetary policy report meeting. That's when they update their forecasts. So they will take the budget into account for that one. So it was all pretty much, apart from the votes, it was all pretty much standard stuff in the statement. But Bailey, as he can do, popped up on the presses later on the afternoon. He popped up on the BBC to say we are on the way to an interest rate cut. He said it was reasonable that financial markets were pricing in 2 or 3 rate cuts this year, but warned he would not endorse that view. So he likes the view, but he's not going to commit the BOE to saying that they endorse that view. Then he was up in the FT as well after the meeting, saying that he's increasingly confident inflation is heading towards target, that confident line that all these central bankers seem to be using. He's scaled up his confidence to increasingly. So the market has now obviously rejigged its rate cut expectations. We're now fully pricing 3 rate cuts, based on 25 pip cuts for this year. That was up from 70 pips, 70 basis points, and now 75 basis points before the BOE. And Bailey, he's now coming around to opening the door, saying we're getting closer to rate cuts. Still a ways to go. So he's not he's not gone full dove, as he can tend to be, but his feathers are changing, shall we say, from one to another. No real changes around the date, though. There was a little bit of pricing for June, but the market's still heavy into August for those. So that's probably the next thing to look for if they start to indicate that maybe we get something earlier than August. But saying that 2 to 3 rate cuts are reasonable this year means that we'll be clock watching as well. The further we go without cuts, the more they'll potentially have to squeeze in, which is something that looking at for the Fed as well. What did you make of Bailey yesterday? A bit of a difference to the statement.
Yeah,
in the end.
that's what I've said, and what my quite kind of questioning was going into the Bank of England. His inner dove is trying to break loose again. Hasn't given into it completely yet, as you say, but that was a hint that he at least is starting to feel confident. We did have those lower CPI numbers. The rest is still like bobbing and bobbing around. Green shoots as well. But that, and you know what, I think the market was just long sterling going into the meeting. I mean, I'm not representative of the market, of course, but a few of us long sterling Swiss, and I guess a lot of them, a lot of people in the market were just long sterling. And now, as we've seen so many times, the pendulum is going to swing. So we had a big rejection of the 128 in the cable. We're already trading more than 2 big figures lower. Yeah, I think we did this. This is a bit natural as well, where we were, or they, and the market pushing back against earlier rate cuts. It does seem, when you listen to him, without going to think too far, he seems to start to align with all the rest, like ECB, Fed, Bank of England could all happen in June now, right? And instead of having to wait for August or after the summer break, as we were planning. So the market has to reprice that, has to manage their books in duration and all of that. And I think that's what we are seeing in sterling. But I think the main one was, of course, we have a dollar move after the FOMC. That move has been completely undone. and the market probably long sterling and needing to reprice some of those gilts and stuff.
Yeah, I think the market might get a bit too dovish if it thinks the BOE is going to cut the same time as the others in June. It's going to need the data to do a lot more, and I'm inclined to think it won't go as fast as what they would like, purely because it never does. So I'm still think August is becoming for me a bit more reliable as a potential date. But you know, we're all data watching. So if inflation's down at 2.5% or less, you know, by May, then June is probably right in the frame. And we keep an eye on those wages as well, I think.
Yeah, yeah. But I don't, I think if we see another leg down in inflation, wages won't matter too much.
Yeah.
Because he doesn't want him or them to be the reason why all of a sudden the economy may start to sputter a little bit, and then the wages come off without them having cut. You know, it's going to be a bit of a bit of a delicate delicate walk from here. So
yeah.
Knowing Bailey may come perhaps that little bit earlier, and he may like to be at the same time than the others. I'm just looking at when they are compared to. So we do have the ECB and the Fed first in June, right? And the Bank of England. So 60th ECB, 12th is FOMC, 20th is the Bank of England. So there may be a little bit of an excuse coming there as well.
Yeah, but I think also it gets a bit funky in the next quarters because April we get a couple of banks and May, and then it sort of skips. So yeah, it's because what some of these have meetings 8 months, 9 months, and whatever. For example, that we got a BOJ in April, and all the others are in May. So yeah, it's like the ECB is in April, but not in May. So yeah, it gets a bit funky around those times. They're not all got central banks on the same week, thankfully.
Yeah, that's why I'm thinking June is sales month, mate. Amazon spring sales now. Central banks will have June sales.
Yeah, and yeah, I mean the ECB could really nail the June date in at their April meeting, if they like, because they're not going to have another meeting before then. Whereas the Fed and BOE are going to be a month before their June meetings. So
Nagel is really changing. He's a changed man.
Yeah, seems so. Well, the economy's in the toilet, so there's no inflation there, and that's probably why he wants rate cuts, because he's hoping it's going to help their economy. You know, particularly after that PMI data we got yesterday, but there was a bit more data out today, which I'll get to in a moment. On the data front as well, for the UK, we had retail sales, which they came in flat and a bit positive on the core sales once you strip out all the fuel and whatnot. So that beat expectations, keeps those greenish shoots alive coming up in spring. So you know, that's another thing for the BOE to consider if we're going to see an economic pickup that may have some inflationary pressure with it. But we're going to just have to watch the data like everyone else. It was the well, we had some import prices there just quickly coming in flat and not as bad on the year. So, you know, maybe a bit of a halt in the slide we've seen in some of the price components there. The IFO came out and that was altogether positive. Business climate itself jumping to 87.8, so up over 2 points. Current conditions as well, nice jump there, as were expectations. So the IFO at least looking a bit more positive. The zoo was as well, although that's still some deep negative numbers there. So maybe sentiment is starting to improve, but that sentiment has got to turn into orders and activity. So that's what needs to be seen. As Kay mentioned, ECB's Nagel said the probability is increasing that we'll cut rates before the summer break. Then some June cut has a higher probability than April. Hawke Holtzman, he's not really ready to give up the baton, although he has sort of hinted that rate cuts are probably going to be the next course of action. He said this morning that he sees a string of inflation risks and that everything is open on interest rates, even that investors should consider the risk of a no ECB cut. So he's just not willing to cast his vote on the cut side anyway. Yesterday we had a bit of data out the US. We had Philly Fed numbers, which came in. It was okay. It was up instead of down 3.2. Some of the other numbers underneath as well. CapEx shown an improvement. Employment had been negative and it was just less negative. New orders turned around a loss to a positive. Prices paid though were a bit weaker. That's the inflationary measure. Again, these regional surveys aren't really telling us an awful lot in terms of a trend or anything. So they're just a bit of fodder at the moment, obviously until we get the ISMs and whatnot. We did get the S&P Global PMI coming out. And there was a touch improvement there, 52.5, beating expectations, small up on last month. Services, though, went the other way a little bit, 51.7. That was a bit soft. The key thing from that PMI was that, things are looking okay, but there's still a ton of inflationary pressures coming in, be it from wages, be it from prices charged, and even input prices aren't falling as fast as they were, things like that. So there's still some big inflation pressures, and that's a big worry for the Fed. As we know, inflation has been creeping down in the PCE, but in the CPI, it's been going sideways for 8-9 months now. And that's something that Powell acknowledged as well. So bubbling underneath the surface, a lot of these PMIs are still inflation pressures. That may lead to a bit of central bank complacency if they keep thinking it's all going to keep coming down, and then all of a sudden it starts staying high or staying where it is and going sideways. So yeah, I'm not as confident on them getting their inflation numbers than perhaps they are at the moment. But again, we can only judge it by the data. Existing home sales were out as well, decent numbers. That's another round of decent housing coming in from some of the main numbers. Prices as well, looking good. Median prices jumped to 384,500 from 379,000 last month, and that's also up 5.7% on the year. Bank of Canada's Gravel was out waffling about QT and bits and bobs like that. Only real comment was saying that Fed inflation data was very encouraging, but it was only one number. Banxico, they cut rates as expected. The decision was 4-1 in favour, with the one wanting to keep rates on hold. Forward guidance was lacking, fairly loose. There was no real commitment to any future cuts. They're data watching, so on and so forth, and they will take each meeting decision by decision on what they do there. Kay, I know you was around for Banxico. Anything of note from them?
Neutral, very, very neutral, I'd say. Yeah, they cut the rates and that's it. It didn't really move at all. The Mexican, the dollar makes crosses even a tad better because dollar makes didn't move much. This morning, it's not a delayed reaction to Banxico, I reckon. It's just dollars being beat, emerging market. Well, dollar China much higher, dollar rand much higher, and I think dollar mix is going a bit in sympathy. And that's about it right now. There's not much to be said, although yeah, you're on the dollar mix there. It's starting to be interesting if those levels just around 1670, 1660 start to hold, right? This is perhaps encouraging. We are going to have they have their famous half-month CPI coming out today in about an hour, so that may be a bit of an interesting watch there. It's expected to rebound just slightly or stay where it is really. But okay, I mean, about Banxico, they also see they've seen their inflation coming down. They revised their forecasts slightly upwards, but nothing to put their supposed slow rate cut path now in danger. I think the next one, let me just quickly check my sheet. The next one, May, just a week after the FOMC, and then June, a week after the next FOMC. So I guess one of those meetings, we're going to see another quarter. They're moving a lot less fast than the rest of the LatAm banks, or some of the other LatAm banks who are cutting 50 BPs by the shot. So that may keep the mix somewhere better, also thanks to its US proximity, the nearshoring, friendshoring, you know how it goes. That may still underpin the mix a little bit. So I'm less worried about shocks in Mexico right now based on that. Um, I'm I've been talking about it before, but I think it's going to get more interesting, really, in the Mexican peso for, let's say, more violent or bigger swings once we're getting closer to the US elections.
Yeah, no, I agree with that, mate. And just while you were talking, I just nipped a little bit more off me long down here, 1681s, because I've been getting the itch to try down here, so I finally did it. Not a big trade, but yeah, let's see where it goes from here. We obviously know where the big levels are up into that 17 handle, and but still, you know, even through all the what's going on with the Fed and everything else, this hasn't shown any signs of turning around at
No,
all. You know, we've had little bounces and whatever. You know, even that bounce here, which was significant up to the 1850, that wasn't
that
even
was when they
38.2,
announced their
was it?
FX program, right?
Yeah, yeah. But you know, the Fed have this has been while the Fed were hiking, and now they've turned, and you know we're still down here. So yeah, it's setting up to be, like you say, something. This level's proving to be a very solid level for now, but the proof is in the pudding. It needs to bounce. If it does something like Euro Sterling, which is, you know, just bobble around not far from it, it keeps the downside in play. But yeah, the level's level until it's not. That's my theory anyway. That's how I'm trading it at the moment. That's it for me for the headline front, unless you've got anything else, Kay.
No. Everything good and good. Upcoming today, we have a Fed listens session, and we should
Great.
hear from the Powell around 1 p.m. GMT, right? So I mean, we can assume that
You
he's
know
not
what?
going to say anything new there,
Yeah,
but
they're not supposed to speak until after Saturday following a meeting. You know, they need to give us this peace and quiet for a couple more days.
yeah, but I don't think he's going to say anything fresh. But you know how the market is, this dissecting every word of what he may say. So we may have a wobble or two come early afternoon for us, morning in the US, and then bar or what is it, and Bostic I think later as well. But I don't think there's going to be anything new coming out of that. So I guess we are just going to watch yield watching and equity market watching, I guess.
Yeah, I'll leave you to cover Bostic at 8 o'clock tonight, mate. I'll be
Sure,
long gone.
sure.
I'll be long gone.
I can do it now if you want.
Yeah, you go, mate. You go. Right. So what's going on? It's all a bit funky today, depending on what you look at. Let's come in. The dollar has picked up. Now it's a bit of a strange day because dollar's looking well bid, except in dollar yen, which, as we should expect, is probably in its own little world right now at the moment. Yields in the US, yields generally are coming down. So usually, if yields are coming down, particularly in the US, you wouldn't expect to see a strong dollar. That may be again just one of these knockoff effects from the FOMC. You know, if the market still is now buoyed by the fact that it's still going to get 3 cuts rather than a more hawkish 2, That could see a bit of bond buying, people locking in that high yield, because now cuts are going to be more than a lot of the market expected before the FOMC. So that could be a mechanical effect. I think there's also a bit of just general realization, with the SNB cutting, the ECB, highlighting June, the Fed still going for 3 cuts, maybe a bit of realization after all these banks this week that we are entering a cut cycle. However slow that may be, or shallow that may be, rates are not likely to go up anymore in the majority of central banks. So yeah, maybe a bit of realization there, just feeding into the market. And also we're looking at the speed of things. The Fed still really haven't nailed a date, as opposed to something like the ECB, who have pretty much tried to nail a date. So we're still trading around the calendar. Who's going to be the holdout? Who's going to be cutting last or cutting slowest? And that's going to affect the flow. So I think that's a bit behind maybe what we're seeing in a lot of markets at the moment. Sometimes markets need just a day or two to let the dust settle before making a decision on where it wants to park money and whatnot. But here we are, key levels in play. Euro dollar, right bang on this 61.8. Big level anyway, 108, 107.90s. We bounced on a first test at least from around 08, 07. So that's looking okay. I've got a little bid in at 05 myself. But if we bounce from here to sort of 40, 50, back up maybe to the zone or whatever, and then come back down again, I'll be less inclined to keep that order in, because I wouldn't like a quick return back to this level if we get a decent bounce. That's if it bounces at all, which it's not doing at the moment. So I'm going to be watching this area here at the moment. If we do hold it, as I say, I'm looking to add to my longs just to see if we get a move back up. But for now, the trend has been looking like it's under a bit of pressure at the moment. We went through the 38.2, we've gone through the 50, which held a couple of times. The 61.8 is always the line in the sand for me. If we do break that, 107.60s, another old number, and then we're looking at the low 127s from here. Resistance, the zone, as always, be it 30s, be it then 70s. And then obviously back up into 109s again. So yeah, going to be an interesting watch to see where this finishes the week. I think, Kay, if we're above, maybe we've had the reprice this week, and we're back into ranges. Do you think?
It's a range until it's not, and for now it's still a range. But I'm slightly on the other side of the spectrum, and I've got the impression that the night of the FOMC and the morning after was the odd one out, where the market had to reprice their expectations, because they went in too hot into the Fed, and then had to get out of all this whatever. And I think that it is. I'm slightly on the other side. But as people know in the room, I've actually sold some cable very. I was up at, I don't know why, probably because of the Bank of Japan still also. But I woke up like around 4:30, 5 o'clock, and I went like, nah, this cable is not going to hold. So I sold actually a bit of cable, bought some back. I'm on the other side. I think that not really Tina, but not far from there. We're seeing those equity markets hold up. We're seeing the dollar hold up at the same time. We are if you look at the 2-year dollar, we are just back at the dots, and now the market is there, and that could be actually a case for even a lower volatility environment. And lower vol environment says normally relatively positive risk, which means yeah, something like EM or MEX could even do better. But this is not really where we trade now. But we could be in a period of actually less volatility on the rates. And then yeah, we will have to wait for the fresh data. But I think the return of the dollar, what we've seen from yesterday is kind of telling me that it's still on the stronger footing. And of course, you can look at different pairs, because that is what we do. We are not trading Dixie or whatever. We look at stuff, and then I'm of course thinking about the dollar Swiss. And then I was very unimpressed exactly there by what the cable did. And yeah, I think that's what pushes me into saying that it was a bit of an odd one out after the FOMC, and now we are back to what we were doing before. And just to reply quickly to Rick, what you say about Japan, is this positive for dollar yen still go up? You know, Rick, we have seen this whole positive environment and the reaction post Bank of Japan, because the Bank of Japan is still only at 0 to 0.1%, right? Which is still a very big difference versus what central banks, like for instance in the US or the Eurozone or the UK are having. And that already mechanically is not supporting the yen. Then you have an equity market which holds up extremely well. You see highs in the Nikkei still being printed, and that usually people kind of hedge their yen exposure as well, and that is usually also a little negative yen. But negative yen doesn't mean really negative in the sense of downbeat for the economy. It's actually the opposite. But now the positive, if you talk about specifically the dollar yen, I would pay extreme attention to what's going to happen at 152, because we have tried 3-4 times now, and it's not going through. So there may be stuff really happening there, and it looks as if there are people lined up there, whether it's the exporters, whether it's a few of the mega banks that the Japanese officials use as submarines to try and cap the dollar yen, could all be the case. I personally think there's big barriers up there, because it's now very typical of barrier scenario, what's happening at 152. I've done a load of them over my career when I was market making yen, and it looks really typical that there is a lot of barriers there. So that is going to be a level that you really, really, really will need to pay strong attention to. Okay, if you and then if you look at the global picture, if you're taking it out of the short term, but if you look at the global picture, even if Fed, ECB, BOE start to cut by 25 BPs, and the best is what we can expect out of the Bank of Japan, another 15 BPs in October, then it's really still going to keep that kind of pressure on the yen. But then we will have to see what's really happening in the yen interest rate market. If you see, for instance, the 10-year JGBs move up to 1%, if you see the 20-year move up closer to 2%, then there is a risk for the other side, because then there is a risk that Japanese insurers, corporates, the GPIFs of this world are going to start to repatriate funds into JGBs, because the hedging costs to be elsewhere are too high. So it can become a quite complicated scenario going further down the road. But in the short term, it's not negative. I'm sorry, the whole scenario is still not very positive Japanese yen in the short term. Okay, so be careful, just be careful about the big level 152. That's all I can say right now. I'm slightly positioned through an option for it to go for the break, but it's really just in the eventuality of, you know.
Yeah, very much, mate. I'm the same. Any other pair, if we had a level like this, any other pair, I would be piling in some buy stops for a break. But just with the intervention risk, I'm still not sure whether the MOF or BOJ, whatever combined, still see that as a level. As I said, they've intervened and jawboned around it twice now, and as I said, once raises an eyebrow, two times raises a flag. You know, if we hold here again, that might suggest that there is something big going on here, be it barriers or something else. But with that intervention risk, I'm not gonna chance a barrier break. I might have a little look at the options myself, see if are they still fairly cheap above.
Yeah, that's the thing, Ryan, and that's why I like to do those for the people who can, of course, do options. I think it's a very nice tool to, because at the start you only pay away premium, right? So you know exactly what you are going to lose, which is already a quite disciplined trading approach. And the way I'm trading them is that you only need to be right once, and then you start to trade around your delta basically. And so and that keeps me now out of danger of that 152, because we would be very tempted if you do cash to do something at 152. Imagine you go short at 151.90 because it's a brick wall. Okay, then you can be right for another day, and then the next day all of a sudden you wake up and in Japan they've broken it and you're trading 153.5 and you're looking at a big hole in your account. Or as you say, you go for the break and then they intervene and you're looking at a 4 big figure drop the other side. So that's why I really like to trade options, and I use them really a lot.
Yeah, it's juicy, but you've got to know that there's heightened risk around it for all these things. So yeah, it's not something you're going to be messing around for 20, 30 pips in this, because you say get a break or get an intervention and you're going to be well offside very, very quickly. Right, looking at sterling again, we've got a bit of a move finally in the old snail, euro sterling. We're now up, knocking on the 86 door. We've had a little mooch above it by a couple of pips, but we finally made a break one way or another, and it's already starting to look like it wants to try and hold this break. You know, we had a move above to 80, this sort of 70s, 80s zone. We had a little dip back, you know, got under 70, but it held. You know, there's no real one line you can draw along here. It's probably a little bit of an area, as you can see, just these little highs and differential highs. So this, probably call it 65, 80 maybe is the zone you need to look for on dips now. If we come back, get back below that, and we're back in this box, and we still haven't pushed away far enough from this 85 level to be comfortable. I certainly don't feel comfortable even while I'm long. But if we do continue, you know, 86.20 is our next hurdle. That's again another little zone in there that we need to keep an eye on. Probably a lot of this, because the dollar is generally stronger, a lot of this is probably the usual volatility difference that you get between cable and euro dollar, i.e. cable will always move more than euro dollar does. Yeah, there is some obviously daily influence in this as well, so it's probably adding to that as well. But I think a fair bit of this is that volatility difference that we can see often as well. So if we do get a bounce, you'll probably find cable again will bounce stronger than euro dollar, and then we'll see euro sterling coming back in its box again once more. But for the moment, I'm out with a slicer and dicer as we move up. I'll keep adding back in here on dips and lobbing them out when we move up while keeping a core position. So yeah, we've moved away from the 85. Pressure's off a little bit, but it's going to take a little bit more to loosen that pressure further. Right, Kate, I haven't left you that much time. You got a couple of choice.
I mean, yeah, I can show you like a couple of things because we had pretty big moves in the metals. So first of all, gold, and I've been telling you about this, right? About that 22-20s zone. We had a look. We had a look into it, and then a very big rejection, and now we are already closing in on the support zone. We're trading around 2167-ish. 21.5, I think, is your level to watch. 21.48, 47. Okay, always give a few bucks for the algos, and that brings us back to that December spike, strange spike that we had, if you recall. But we have traded, tested the level, and then bounced for that steep move higher. Okay, now we are back here. Rejection of those moves. So I'd say 21.95, 21 and a half. Those are the levels that we need to watch to close the week. If ever there's more liquidation to be done, I'd say there's a possibility to go back to low 21s. Okay, I'd be surprised if we can get down here below 21. But if we would get back below 21, I may start to try and catch a knife here if we get below there, between 23 quarters to 2090 or so. That would be really a big washout, and to me good enough to perhaps start to load a few up again. Silver, similar. But I showed you these triangles, the smaller one, the bigger one. The levels coincided and came together at around 25 and a half. We had a bit of a fib around here as well, and we went up there, tried to break, and then we had a big rejection. Same thing as on the other metals, same thing as on gold. As we know, silver tends to be a bit more volatile, perhaps, than gold. So we had a full buck of retracement already. Neutral would be, to me, to return to around 2380, perhaps, that to bring us back inside and around the midpoint of those triangles. 2380 around is a level that I'm going to keep an eye on. Okay, if ever it gets back down there, then I'm going to load them up again, and I'm just playing around my long-term loans, and then when it flies, taking some off. When it dips, I'm buying back, and then don't change this kind of scenario until we need to change it. Okay, but it was a pretty decent cap, and it's a bit like all the rest that happened in the dollar. If you look at it, we've had the setback in the euro dollar from the highs. We had the setback in cable from the highs. The other one is which was like, whoa, you get a very strong labor report, and we lost everything and more. We lost even more than when we were trading. Well, no, actually, that was the FOMC, right? So we're back to pre-FOMC levels, but we are back below or around that pretty important zone. So I guess that on the Aussie, anything below 65 and a quarter or above 65.40 is going to be relatively important to see where we close the week. And then we look on where our Swissies are trading. A bit of a setback on the Swiss crosses, because I think it's the other side of the Swiss pair that is doing it. So we had a move up into 97.75 on the Euro Swiss. I highlighted that level, taking some off. Now I think I'm not going. We can chart it in shorter term, but I'm not going to do it, because I still think that this zone here, 96.75, 90. For this move in the Swiss, after what the SMB did, for this move in the Swiss to hold, we're also going to have to get help of this pair, the Euro Swiss. And you know why? Because I've been talking about it very often. I think this is key here now for this break to hold after the SMB. 96.75, 96.90 on the Euro Swiss. The dollar Swiss also went for a walk, showed the longer term in the room. We are well inside the weekly cloud now as well, which is positive, which is just above this key zone here, which is around 89. We are a big figure away, of course, so that's a while away. But again, these are the key levels that need to hold. So any dollar weakness that we will see is going to have to hold the low 89s now for it to continue. Okay, we can have these kind of moves up and down, but any weakness should now hold the 89s. And here is the next level. We went close to it. 90 and a quarter. 90 and a quarter is what needs to break for it to continue higher. And this is still only, okay, it's October. It's a bit before the real year-end dump started. But I think this is the next key level to the top side, 92.5. Okay, that's on the dollar Swiss. Sterling yen, but then really quickly, because okay, I think it's a big rejection of those levels here, and we're already back below 191.5, which is a level that I think mentioned before as well. So this is looking a bit negative for as long as we stay under 191.5. Now, this is this cross, okay? So keep an eye on your dollar yen. Don't forget your dollar yen. If dollar yen flies through 152, sterling can do whatever it likes. If we get the big acceleration, all these levels that we see in the yen process need to be really, really taken with a large pinch of salt. Kiwi CAD, I don't have anything, but I'm just going to put it up. I don't know, but if I look at it already like this looks to be a bit of a triangle to me, of which we are not too far from the downside. And if I look at the really global picture, like this, it doesn't look like we are ready for a medium term, I'm not saying short term, okay? It doesn't look like we are ready for too much of a bounce here in this one. If I look at the medium term, could see a bit of a perhaps move back up to 83 and a quarter if it wants, but I'd be a bit worried because we are also on the February low here. I'd be a bit worried if that gives way, or if low 81s give way on the Kiwi CAD, okay? Doesn't look extremely constructive to me if I look at this one. Perhaps on the shorter term, but I'm not sure. I'm really not sure here. No, this does not look extremely constructive to me, this one. All right, back over to you, Ryan. Have a good weekend, everybody.
Thanks, mate. And yes, echo those thoughts. Thank you, as always, for your insight and your charting and your views, Mr. K. Thank you all to our viewers for coming and watching us this week on the Flow Show. Hope we've steered you in the right direction on a lot of these events. Your support is always appreciated. Have a great weekend, everybody. Rest, get your head clear. We do battle again on Monday. Have a good one. Thanks.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.